Based on what you see in the economy, because you have a pretty long lead.
I think when you talk about the risk of the Fed doing it too much, too fast, there's also a risk of doing too little, too slow. And of course, it's easy for people who own assets today. It's all about lower rates, but the fact is, a strong economy, normalizing rates is a good thing. So, my guess is the Fed's going to be looking at data right up to the last minute, and that they probably will do December. I don't think the Fed should be overreacting because the stock market went up or down, or people are afraid of trade, or stuff like that, or possible geopolitical events. And normalize is a good thing. The world will be much happier if America's growing and rates are going up a little bit than if we have a recession and rates go down. It's better for the world. So I think they'll probably stay on course, and of course people are going to adjust their speculation on that issue. So,
I mean, you have a very good idea of what's happening in home mortgages because of all the mortgages you make there, and in car loans. And that's been some of the areas that people say, look, things are really weakening there. Is that because rates going up, or is there something else happening?
I don't think, it's not weakening. Car loans are being made, 17 million cars being sold. It's humming along. I think a bunch of people have gotten a little more conservative in subprime auto. That's a very minor total effect on the United States economy. And home mortgages, mostly because rates are going up, and that the option adjusted spreads and mortgage going up a little bit, so it's a little more expensive to get a home. If I was the government, I would go out of my way to expand the credit box. Right now, we still have restricted credit to a lot of buyers because of all the mortgage origination, securitization, purchasing rules and stuff like that, and that could be fixed and doesn't create any extra risk. It just reduces the cost of mortgages to a bunch of people, and it opens up more people get mortgages.
What has to happen for that? Who would have to sign off on that?
We need securitization requirements. Okay, we still don't have them 7 years after the crisis. That alone, so you're allowed to securitize and get some of the stuff off your balance sheet in a very, very safe way. That would be great for the mortgage market, reduce the cost of all mortgages.
You say securitization and everybody immediately thinks, oh my gosh, we're going back to CDOs and all the things that cause the problem.
That's not the way people should think. There's good and bad. There are good CLOs and bad CLOs. There's good this. I mean, it's a bad idea to think that securitization is a bad thing. It's a very good thing. And remember, the buyers are top-notch professionals too, so it just allows institutions to make mortgages to have another way to sell them, a cheaper way, and it makes it cheaper for the individual. And the credit box is more, with all the litigation after the crisis and FHA and all those things, what happened is a lot of banks and non-banks, they don't go right up to the limit of Fannie Mae and Freddie Mac. They put overlays, a little more tighter appraisals, a little more conservative appraisal, a little more conservative income, and that hurts lower income and homes valued between $200,000 and $350,000, and that would be a good thing to make those mortgages more available. So there's always a solution to issues, and but obviously rates going up reduces mortgages. But in American history, there have been a lot of times when mortgage rates are going up, home prices continue to modestly go up, and the economy continues to grow. It's not an automatic